And his advice was find the companies that you really love and that you're all about, right? That you can look down at your shoes. What type of shoes are you wearing? You can look at your clothes. What type of clothes? Your watch, the computer you're using, right? Like your mobile device. Take a look at all the products that are around you and what you're using, and start to invest in the company as opposed to the products.
All right. Welcome back, everyone. We're here today with an awesome guest, someone I've been following for a long time, Ari Gutman. Been following him since the Blue Lion Finance days. And we're going to be talking about all things dividend stock investing. Super excited to have Ari on here. You know, I kind of got my start with dividend stocks, moved away from it for a while, but I'm kind of starting to come back to it. I'm seeing the importance for sure. So glad to have you here, Ari. How are you doing today?
I'm doing fantastic. I first want to say, man, it's a pleasure, an honor, and a privilege to be on with you. Of course, I'm also on your channel, and I love what I'm seeing. Love the fact that we're both on here, you know, just helping other investors out there. I feel like it's the most powerful thing, you know, we can do, not only as creators, but just the average Joe investor, to show others what's going on and at least to just get started somewhere.
For sure. Yeah. You know, just democratizing this information. And I think it's really cool to see what's happened with just everything becoming more decentralized and having things like YouTube and having podcasts and really being able to just get the knowledge out there and make it really an even playing field, like where anyone can succeed. It is definitely exciting times we're living in.
Yeah, 100% agree, man. I want, before you ask me your first question, I want to ask you a question. the question I asked you got into dividend investing and then you tapered away and now you're coming back, it sounds like, which is super exciting for me to hear. Obviously, I'm a dividend, investor on YouTube and always talking dividend stocks, but I'd love to know, just from your end, what got you started with dividend investing, and welcome back to the family, brother.
Thanks. Yeah, it's good to be back. So I never abandoned it. I always held some dividend stocks like Realty Income, things like that. I have like some VYM, SCHD, but I definitely, 2020, 2021 just shifted the bulk of my focus to like things like Tesla and like hypier areas of the market. And, I love Tesla, huge fan. Like that's my number one holding. I do believe in that company, but definitely got caught up in some other ones that, now I realize looking back, I think there's really no substitute for skin in the game. Like there's only one way you learn these things. You got to go through it. And it was definitely just very eye-opening. Like I'm kind of glad 2022, the market crashing and everything, just like getting hit with reality and basically the worst case scenario. And it made me start to realize, you know what? I like to sleep at night. I like when my portfolio is not dropping, 50%. It's nice when it goes up 50%, but it's nice to sleep at night, and dividend stocks definitely help you do that. So I think like right now I've got, it's pretty sporadic, but maybe, I have a handful of dividend stocks paying me like an average of $400 a month. And it's nice. Like it starts to add up quick, and it's something whether the market's up or down, got my dividends coming in. So definitely something I want to, start to build up more of. I have like a few stocks I'm looking at that we could get into that, I think are good ads that I would put in like a long-term focused portfolio. So yeah, that's my dividend background, and just watching people like yourself and, people like PPC Ian I've been watching for years. And definitely, liked the dividend stocks. Definitely some benefits there that we could get into more too.
Of course, man. Yeah, let's do it. I'm excited. Like I said, man, it's an honor to be on with you, and fire away, man. Let's do this thing.
Awesome. Well, yeah, thanks for coming on. And before we jump into all the dividend stock investing, I just wanted to ask, who is Ari Gutman?
Wow. In a nutshell, I'll go with in a nutshell, man. I guess I'll start. I always like to start from my younger years, because I think, as someone looking back now, like the one thing that I always am trying to share with other people is like, just get started. And, when I was younger, I was just a hustler, man. Like I was always out there hustling for money and tucking it away. I think I had, literally started 7, 8 years old and would just tuck money into my sock drawer, right? And over the years that just amassed, and I never invested it. So, it's like the one thing I always like to share with people is like, just start, right? Like take risks, start because I started, I think, far too late, and I started in my early 20s, I think 2021. But I'll jump back into the Ari Gutman story. So always a hustler, man, always out there working, trying to do my best to just get more money, save more money, and then build out my dreams. And, I'll jump into the time in which I got to investing was in college, actually. And I recognized a couple of things. First of all, my uncle worked at Fidelity for 25 years. And he, for me, was like an icon, a Fidelity icon. Every time I would go to his house, it would always be, me and my cousin sitting around the table, and he'd have a newspaper out, and he would be reading the paper, Wall Street Journal, right? Going down the list of tickers. And I was just fascinated. I had no idea what was going on, right? But I was fascinated by it. And when I got to college, it was his advice that really intrigued me. Although I feel like I really took his advice only 10 years later, right? Because I was going there early teens and always seeing him. And then boom, I'm 20 years old and I'm sitting there. I'm like, why have I never taken my uncle's advice to jump into the market? And his advice was find the companies that you really love and that you're all about, right? That you can look down at your shoes. What type of shoes are you wearing? You can look at your clothes. What type of clothes? Your watch, the computer you're using, right? Your mobile device. Take a look at all the products that are around you and what you're using, and start to invest in the company as opposed to the products. And it was such simple advice. And that's when I initially got started with investing. And I'll say it was with ETFs because I was still very risk adverse. And I'm still a risk adverse investor, obviously, as a dividend investor. But yeah, man, it was the ETFs I started off with. VTI is still the largest position in my portfolio. It's the one that I started off with. And I felt like, in my early 20s, I wanted to build an investment foundation. And I ran with the whole theory, right? Rome wasn't built in a day, but the reason why they lasted for so long is their foundation, right, was just laid perfectly. So lay the brickwork of a portfolio perfectly. For me, that was the sound off for an ETF or indexes that are out there. And that's actually exactly what my uncle at Fidelity did. He managed ETFs and indexes. So that was where I started. And then taking more of my uncle's advice, right? What products am I using? It was all about looking around me and realizing that I had Apple everything, and realizing, right, that Apple's probably going to be around for a long time coming. So my next position was Apple. My dad worked as an executive at Johnson & Johnson, and the power of healthcare, I think, as an investment of any sort, because we're always, as humans, going to look to live longer, healthier lives, was the next best brick I wanted to lay on my foundation. So it was by default, I started building the dividend investment portfolio. And not long after, I found guys like Andre Jick, who were out there, and they had the YouTube channels with the monthly dividend income, the totals, how much they're bringing in. And it hooked me. And then there was the Jason Fiebers of the world. And I don't know if you're familiar with this one, Vinny, but Grant Sabatier, he wrote a book on financial freedom, passive income and financial freedom. He's all part of FIRE, Financial Independence, Retire Early. And I was like, man, Grant Sabatier graduated from UChicago a year before my brother. And that meant he was 4 years older than I was. He was financially free by 28 years old, 29 years old. And I'm like, what's the secret here? And it all looped into passive income. One of the streams could be real estate. Another is dividends, right? So it's build your passive streams. And voila, I feel like Ari Gutman as the dividend investor was born. I hope that summed it up for you.
Yeah, no, that's all so much great stuff to unpack there. And, just going back to what you said of basically just here's an idea from another Fidelity guy that I love, Peter Lynch. I wonder if your uncle works with him at all there, but he was a proponent of just investing in what you know. It's pretty hard to lose when you're, or at least using it as a starting point. What are the products you're using? What are the stores that are busy? Looking at it that way, because that's the starting point. And then if the financials paint the same picture, it's popular. You want to be investing in products you believe in and that are popular. You're probably gonna do pretty well. And then, yeah, as far as the indexes, I think you're right. Like building a strong base. I had lots of index funds that I've actually like sold off for the most part now, because I kind of feel like for me it was like it's good training wheels, right? And I think most people that aren't as into the markets as we are, they're great. They're hard to beat, right? But I just feel like instead of owning the S&P 500, like I'm at a point here where I could just pick the best of the S&P 500. We'll see. This all remains to be seen. But I just think over a 10-year span, like I think I know what to look for now. And you're right. Like you can build this solid foundation. You don't need to go out there and be trying to hit home runs. I mean, well, if you can get to the point where, let's say you have 100K invested and that's paying you a 3% dividend, which you'll probably get that off of just a broad market index fund or pretty close to 3%. All right, well, now every year you have 2,000 or 3,000 coming in that if you want to gamble or speculate on some other stock, like it makes more sense to draw from that. You're probably going to get to a point where you no longer want to speculate because you just want to keep growing the snowball. But I think the mistake too many people make, and I've been guilty of it as well, is going for something that's more unproven, that you may not fully understand with the only capital you have versus something that is more, surefire to stand the test of time.
Yeah, 100%, man. I can totally relate. As you're, sharing about jumping into more of the growth oriented stocks, I have Tesla in my portfolio. Again, fair disclosure, I call myself a dividend investor, but it's not to say that I don't marry sometimes growth, right, and value together and appreciate what that can create. And I think what's important that you said, jumping into more of the growth oriented plays, especially when you're younger, is so important because you can actually risk a lot of it more, right? And so if I like dividend investing, I love dividend investing, but the reason why I get into, right, I have shares of Amazon, I have shares of Tesla, Google. The reason I have these companies is because I have a lot of time. And also, I don't think they're really risky companies, to be honest with you, but I think some people in the dividend investment world may see them as more of a risk. There's going to be, especially Tesla, right, a lot of volatility. But when you start to think about the longevity of your investment, like your timeline, for me, I'm like 10, 20 years out, like 30 years out. I'm not going to touch this money. Like I have a system for myself where, I get paid and then I am basically divvying out the paycheck into different accounts. And so whatever money finds its way into Vanguard, and that's just the account that I have on YouTube, right? But whatever money finds its way into Vanguard on that brokerage account or my other brokerage account, that's money that's gone. It's no longer Ari Gutman's, right? It's like my future family, the future Ari Gutman, who's going to be 65 saying, hey, thanks to the young buck who thought about me, right? So I kind of just, I think you're right, man. I think you have to diversify, get into growth. You can love dividends, but like when you have time on your hands, take some risk.
Definitely, yeah. And kind of leads into my follow-up was just going to be, it's not often that I see another young man in the YouTube finance world, and it's even more rare that that person has a focus on dividends. So I was wondering, like, why dividend stocks? What led you to put your focus there? I know you mentioned, investing in the things you understand, but, that might not generally or things that you use, products you use, may not always be dividend stocks. So did you start out investing somewhere else, or was it dividends from the start, or just a combination?
There was, like I said, so I had the foundation indexes and ETFs, all thanks to my uncle, and it was kind of like you said, the training wheels, right? I still love training wheels, man. I'll still ride with training wheels all day long. But so I have that foundation that makes me feel very comfortable to throw money around into the market and take more risks, because I feel like I have that cushion of the ETF, of my foundation, right? So it's like I'm never going to hit rock bottom, if you will, like financial rock bottom. That's going to protect me. So therefore, the next risk I took, if you will, was Apple, which again, I don't really consider to be a risk because we're talking about Apple. But building up from there, and Apple just so happened to pay dividends. I don't know if you like, is it a dividend stock? We can go both ways on that one. It's just a nice to have dividend. But the next one was Johnson and Johnson, and I think thereafter that I did start to get into more Cathie Wood like investments, and I got really excited. And this is one of my regrets, to be honest with you. I think everybody needs to really graduate from the University of Hard Knocks, right? That's like number one. Like, you can read 10,000 books and you can gain a lot of wisdom, but you can go out and trial and error one time and you'll have learned just about the same amount of wisdom. And so I think it's like, it's all about getting yourself out there, trialing and erroring, really realizing, right, what investing is all about. And for me, at that point, I think it was like 21 years old. Of course, man, I'm in college. I got super excited. My dividend stocks are doing well, Johnson and Johnson and Apple, right? I must be Warren Buffett, right? I must be Peter Lynch. I must be Michael Berry. But the point is, it's like, I'm not, right? So I put money into some of these Cathie Wood-like stocks, and I can't off the top of my head recall which ones, but I lost. And I didn't lose right away. And I think that was a part of the dilemma, right? Like, I actually, for the first week, 2 weeks, 3 weeks, was up. And I was like, hey, man, like, this is it. Like, I should graduate and go to Wall Street, like, easy. And I very quickly found, like, a week later, right, the volatility hit, and all of a sudden this penny stock or whatever it was that Cathie Wood's preaching about, right, and everybody and their mother is talking about it, is now, half. And I'm sitting there, do I sell? Do I not sell? Will it go back up? Will it not go back up? Now, 2 or 3 of those types of positions never went back up. And therefore I said, okay, I can do 2 things right now as an investor. I can keep going into growth stocks and double down on, more due diligence into these companies, or because I think this is really where the passive income comes in and dividend investing, I could find companies, good, high quality companies that, again, they're probably going to be around next 5, 10, 20 years, invest into them. And what I'll find is that I'm going to have more time to do the things I actually like to do. And fair disclosure, investing is very boring. I actually don't like it. I like to make money. That's great. But I don't like to sit in front of the computer all day long and like day trade or invest. That doesn't do anything for me. So it was all about, again, I think that's also where Grant Sabatier and, FIRE and, just passive income came into play, because it was like, duh, like you have the opportunity to just invest in good companies. And then it went to Warren Buffett, right? Like, what's he doing? Like, he's not investing in any of this, what I like to call crap, like penny stocks. Like, yes, you can get rich. You can get wealthy with it. People do it, but far few and few between. And if you're able to put money in the market and steadily grow that wealth, to me, it's just as good. It's like your scoreboard is your brokerage account.
For sure, yeah. And investing in a lot of these unprofitable companies, like one recently I've been thinking about is like there was kind of this whole like eVTOL hype phase. Like I think there was like a company called Lilium, and not anything particularly against this company, but I just kind of last week I was making this video about Amazon, and I find that in 2018 they filed for patents for basically these blimps that could do like drone delivery for packages in metropolitan centers. And I'm just thinking to myself, like, you could, again, like it all goes back to, okay, having a designated amount of money if you want to speculate, but like very little. But the bulk of which, like, if these things come to fruition, these big companies, these Amazons, these Apples of the world, like they're going to be the ones that are capitalizing on it anyway. So that's just something I've been thinking about. And yeah, I can definitely relate to like just buying, speculative stocks that, yeah, in short term they go up and then they go down a lot. And yeah, it's just a lot of volatility, a lot of headache. And yeah, that's why more and more like I am becoming more conservative, I think. Like right now, like 70% of my portfolio is in Tesla, but I want to like diversify away from it. I don't want to sell it because I do believe
more conservative. It's all Tesla.
It definitely used to be worse, just because it was like if it wasn't Tesla, the rest was like, I always had like some index funds and stuff, but I had a lot of crappy companies too. But my struggle with that one is like I do think it's going to be the biggest company in the world, maybe by 2030. Yeah, there's going to be a lot of chop, a lot of volatility between now and then. So I don't want to necessarily sell it. I don't want to, Peter Lynch says selling your winners and keeping losers is the equivalent to throwing out the flowers and watering your weeds. So it's like, I think it's a great company. I think it's going to continue to do well, but yeah, I don't want to be 100%, all in Tesla. So now, like, I haven't really been buying as much, the last couple of years, and I am trying to like build up other positions to help me sleep a little easier at night, because it wasn't fun in 2022 watching Tesla drop 70%, 69%, whatever it was. And again, it's just like a lot of these things, if they work out to the extent you think they're going to work out, a little bit of money is going to go a long way. So it's like, it's almost like overkill at a certain point. So yeah, I'm definitely
To your point, man. Like, it's such a hard call sometimes, because you do get like the one-offs, right, that like really take off. And obviously it's the Facebook, right, Amazon, Tesla, Google, when Google is just growing, Apple, any of these companies. And I feel like so many of us investors, we find like fool's gold almost. We think a lot of these companies that are fool's gold, they're going to turn into the Facebook, right, Amazon's, Google's. And so it's like, I pick the winner. And while yes, that could certainly be true, more often than not, they're not the winners. And so, no one knew. And I always like to think about this. If you had, in the early 2000s, or I even read the Everything Store, Jeff Bezos's Everything Store, like phenomenal book, but he goes so into detail about starting Amazon and how no one believed in him. And mind you, he wasn't asking the Joe Schmo investor, hey, can you invest $10,000 with me? He was asking, right, the top dogs in the industry. I mean, this is a brilliant, brilliant mind. And he was getting rejection after rejection after rejection. So we like to call those he was asking for money, smart money, right? Hedge funds, the big guys. But they were saying no. But we did have, if you will, a few of the smaller guys, some retailers, his mom, right, his family, say, Jeffrey, we'll give you 10K, right? Like, and I think about that. So it really comes down for me, are you going to believe in the management team? Like, if there is no money involved, would you still sign up and work at that company and show up and run with that executive team? I got to be honest, man, with Tesla, hell yeah, I would, right? Like, if no money was involved and I wasn't going to see a return for 20 years, Tesla for me is an investment into Elon Musk. It's an investment into the future, because this guy doesn't, what is he, living in a box right now? Right? Like,
little bungalow, yeah.
Right? Like what he cares about is building a new planet, because we're destroying this one. And I think about that, I'm like, wow, like, he's a visionary. Steve Jobs, same thing. Like, he was a visionary. And I think sometimes, and I get hyped about this stuff, man, because I'm like, I just see it happen so many times. We're picking a lot of fool's gold, and we're all trying. I always call it getting rich by Tuesday. We're all trying to get rich by Tuesday, man. Enough. It's like, it's okay to build wealth over time, because if you're building wealth over time and you're not rich by next Tuesday, you'll be, rich by retirement. 1.4 million. I just had a guy on my channel. I don't know if you saw this, Masters of the Market chat, but this literally called the Average Joe. He was on, and I didn't even know he was a millionaire until he started talking about how much money he had tucked away. And the guy's got 1.4 million, but he started off on the streets, like literally like donating plasma, right? Like, to get groceries. And here I am on this call. For me, that's a hero, right? Like, that's a guy who invested in good companies, and instead of trying to get rich by Tuesday, gambling his money, he just put it quality companies, good leadership teams, companies that had little to no debt. And here you go, 1.4 million. Now, do I want, right, more money than that? Of course, everybody wants more money, right? Whether you're at retirement or now. But again, I want to think about like perspective as an investor. The chances of me becoming a millionaire, by next Tuesday, because I just invested in the $5 or $4 or $3.02 penny stock. Not so sure about it, man. Like,
yeah, I think
Doge guy though, man, that guy made a lot.
He made a lot, but I don't know if he kept any because I don't think he sold anything, and I don't know. He might be back to just Dogecoin, no millionaire. But I think what you bring up is part of a broader societal problem with instant gratification. Nobody wants to wait. They want, now. Like it's getting harder and harder to delay that gratification and say, okay, I'm going to put away $100 a month that I'm going to be smart with. And maybe 10 years from now, 15 years from now, I'll have $1 million, but nobody wants to wait that long. They want it next week. And I just wanted to clarify too, really quick about my Tesla position. Like I said, it's 70% of my portfolio, but that's because it was 10% and it like 6 or 7x. So that's the other problem is like, I see a lot of people who are like all in, and I don't know that I necessarily agree with that, just because at the end of the day, there's always risk, right? But, again, for me to like, I'm not going to punish it for being a winner. And then I wanted to make a point. You said, like this whole idea, people get caught up on the next thing. There's never the next Tesla, the next Apple. There's just those companies, right? Like anytime I see headlines like that, like it drives me nuts. And it's like, these are probably, great companies to avoid. There's a great book on this called 0 to 1 by Peter Thiel. And, these companies like that become the greats, Tesla, Google, Apple, Amazon, companies like that. What makes them so successful is they escape competition. Right? They are the best at what they do. And then the effect is, you don't have to worry about competing anymore and undercutting your competitors. So now they can focus on solving other problems, bigger problems that, other companies could never even approach because they don't have the time, the resources, the money. And, it's kind of like similar to a monopoly, but, we don't want to call it monopolies, but like a company like Amazon, I think does do a lot of good, right? It's gets us cheap goods delivered to our door. Like it's just, you can't beat that conveniency offer. And I think that conveniency, that's probably a great investment trend that'll continue to, do well over the next decade, whoever's able to make things the most convenient. So the next thing I wanted to ask was, I think you've mentioned on your channel that you've in the past gotten to the point where you have too many positions. And I kind of went through something similar the last few years, probably got up to like 40 positions at one point. And at, now I think it's less than 10. So I just was wondering, why did you choose to get rid of companies? What made you keep the ones you did? Did you just consolidate into like your winners or higher conviction stocks?
That's a great question, man. I also like how you kind of, topped it off with saying you just stick with the winners. And I'll say like maybe short term, like I kept with the companies that long term were going to be the winners. Again, like I am done with this get rich by Tuesday mindset. And, I'll share honestly, man, I started a YouTube channel. I used to teach some classes at Rutgers University of economics and finance. And it was fun. And there was a girl in the class, one of these classes, who was like, you should start, an online, class or channel, whatever. And I started it on Skillshare, and it was a lot of fun. And it was like 1 student, 10 students, 50, and the class was doing well. My girlfriend at the time, this was already, like 4 or 5 years ago, like 3, 4 years ago, was like, why don't you just go on YouTube? And I was like, wow, that's pretty bold, right? Like that's a pretty audacious move for me to jump on there. But I was like, you know what? Like my whole mission is to help at least one investor at a time. And so I jumped onto YouTube, and I'm prefacing with this story because when, as I started to grow this YouTube channel, what got really exciting was, again, like the guys like Andre Jick or Jason Fieber, who had these portfolios that were like 70 plus holdings. And like every month it was like, all these dividend stocks are paying me all this cash flow. And I was like, wow. And 2020 then hit, and like the game was on, man. Like every stock was discounted. And for me, it was just like, I'll take that one. I'll take that one. Like forget window shopping, man. I was buying the store, right? Everything. Give me everything I could possibly get. And that was probably one of the biggest mistakes I've ever made. But University of Hard Knocks. And, I bought all these positions. I think max I was at like 50 something holdings in 2020. And then towards the end of 2020, I was getting the dividend paychecks. Some of them were coming in at like $1.50, 89 cents, and so like I'd have to make YouTube videos that were like, this month from X company, I just made 89 cents. Unbelievable passive income, man. And it was almost silly. And I was like, I feel like I'm not doing it right. And so then I started looking into, other investors up and not retail investors like, the Andre Jicks or Jason Biebers or anybody else on YouTube. I just started looking into Warren Buffett more and like really studying the Buffett way and Peter Lynch. And then actually a lot of the Warren Buffett research led me to Bill Ackman, because Bill Ackman takes a lot of his strategies from Buffett. But you wouldn't think it so, because Ackman's portfolio over at Pershing Square, at the time it was 10 positions, 10 holdings. Now I believe it's 7. But I saw this phenomenal speech, and he shared that at any given time, there's only ever really like 2 to 3 high quality companies out there. And I was like, is that right? Like if I think about the market that's out there and how many stocks I just loaded up on, are all of these companies high quality? And I was like, I don't know. I think some of them are good companies, but I wouldn't classify all of them as high quality. And so it just made me start to question what I was doing. And then from there, again, I went through all the Buffett books again. And it was like, no, man. Like, find the high quality ones, the ones you can hold on to for a long time, never have to worry about like you're sharing sleep at night. And then I made the decision where I was like, I think I'm doing this wrong, and I need to trim my portfolio. Lesson learned. I made money. It's not like I lost money on loading up on stuff. Like, dude, it was dividend stocks, and they didn't. I think like 2 or 3 of them maybe were in the red. Like AT&T is one that I actually held on to, and it just kept coming down. That's a different story, right? What I'll share though is, like, as these stocks were delivering through on dividends, I was like, why not take the capital from the 89-cent dividends I'm getting and pour that capital into these high quality positions I want to build out. So let me get J&J to, instead of 20 shares, 100 plus. Let me get Realty Income instead of 25 to 30 shares to 100 plus. And then I started making these goals of, let me get all these high quality positions to 100 plus. And that's, for me, I don't want to say there's a right or wrong way to invest. Whatever works for you works. Jason Bieber, I love that guy. I follow him. He was on my Masters of the Market chat. And I'm subscribed to his newsletter. Like, I love Jason Bieber, but I can't invest like Jason Bieber. I can't have 70 plus positions, because I'm never going to know what's going on with all of those companies. I'm just not. But I'll know what's going on with 10 to 12, and I'll really know what's going on with like 2 to 3. And so I want to credit, Bill Ackman for that. And of course the greats Buffett and Lynch and those thereafter. But yeah, man, I really think it just comes down to building quality over quantity, and learning though, like, learn as you go. Like, I only learned that that's what works for me because I tried the other route, and it didn't work so well for me.
Yeah, a lot of good stuff there. Like, at that point, 70 plus positions, that's an index fund. You might as well just have an ETF. Why put all the work of managing it on yourself? And yeah, you bring up a company like AT&T is such a polarizing dividend stock, but I think I owned it at 1.2. I probably sold it for like a small loss before it really tanked. But that's just a company like, oh man, like just so mismanaged for a decade plus. And it's like, at what point it just doesn't do it for me. Like, you go back to 2010, like, they just made mistake after mistake. They're overpaying for stuff left and right. They buy DirecTV. 2 years later, they're selling it for like half what they paid. Then they did the same thing with, because what I was excited about was when they bought HBO, I thought, okay, they'll have this whole like streaming thing going. So that was around the time I was buying it. Maybe that was like 2020. And again, it just never goes anywhere. Then they end up selling it for less than they paid. So yes, there's definitely something to be said for just buying the quality over the quantity. And for me, some of the dividend stocks in my head that I have on my watch list that I think I would put in that category, that basket, after I do some more research, it's just things like Home Depot, things like Starbucks. Like, these are not going anywhere. Home Depot can't be displaced. Them and Lowe's, they have a duopoly, right? Until Amazon can ship lumber, but I don't think we're getting there in the next 10 years. Yeah, I don't know. It could happen, I guess, but these are just the types of quality companies that continue to show, even if it's just low growth, but that continue to grow, especially in like 2022, 2023. We're seeing right now, I feel like it's a great litmus test of like what the companies you want to be in are, because they're growing through the good times and the really hard times, and that's exactly what you want to see. There's another stock on my watch list is TJX. I don't know if you're familiar with like TJ Maxx, Home Goods. Low key, like, it is such a I probably got this there too. Like, it's the only place I shop. Why would I pay full price? But yeah, like, if you look, they did well through every recession, 2008. Like, these are the kind of things you want to look for, you just want to be in the quality. So I think you make a really valid point.
Yeah, dude, look, to that end, even TJ Maxx, right? Like, you have to think like, and peg TJ Maxx against like an AT&T. And I think what's interesting is, okay, so AT&T, even Verizon for that matter, right? Like, at one point, they were hot, right? Like, these were the companies to get into. And I think as we continue to modernize, what we're seeing across all sectors is a very rapid modernization. And so I think even when it comes, right, we didn't have cloud, right? When Verizon was the young buck and AT&T was what we had was big block phones, right? And like that was the hot commodity. And so I just think as we continue to modernize, again, and then you touched on TJ Maxx, which I want to bring it back. I don't care how many years into the future we are. This shirt probably won't be a hologram, right? Like, well, maybe it will. I feel like I can't even say that at this point, but like, TJ Maxx will probably be around, and everybody loves a discount. Everybody loves a discount through the good times and the bad, especially the bad times. So what happens, in a year like we had in 2020, TJ Maxx did great. What happens in a year like what was 2022, when the market was in heavy volatility? TJ Maxx did great. And same with Procter & Gamble and Johnson & Johnson and a lot of these companies. So I agree, man. I really like, go for quality. Go for quality, stress less. And if you're going to get into growth, for me, divvy out like maybe 5 to 10% of your portfolio for it. And if you're going to gamble, right? Because I feel like I want to talk about this too. If you're going to gamble in the stock market, just have fun. Go to Vegas. Like, Vegas is going to be a ton more fun than the stock market, man. You get to go to the casino, you get to dance, you get to have drinks, have fun. But right, when you're gambling and the terminology there in the market, like, you're supposed to be an investor. So if you're going to buy the penny stocks, be an investor. Look into the company, do the due diligence on that company, and invest. Don't gamble. And I think I just, like, so many times, man, YouTube channels, friends, families, I host for Tip Ranks. It's where I'm currently working right now, like full time. I have the honor and privilege of hosting webinars and podcasts for them. And what I hear from the investor community, I'm talking about thousands of investors, taking a simple poll of how they're investing, we're not always doing the due diligence. And so the question comes down to is, do you want to be an investor or do you want to gamble? Vegas and Atlantic City are great options for people who want to gamble. But the stock market is your vehicle to wealth. So use it, like, invest, be an investor. Sorry about my tangent, man. I just get like amped up about this stuff.
No, that's a really good point, because the market is not a fun time. It can be very stressful too. So that's like a really good point. It's like, you're not having fun and you're probably going to lose money. Like, what are you doing? And it's very time consuming, right? Especially like, that's why I never was really into, never got into like day trading, stuff like that. It's just too much time, and like, I do some options trading, but more so just selling puts, selling calls, which I think that's a good vehicle. Like I'm never buying because I think buying is ultimately either gambling or you better really know what you're doing and you're sitting there 12 hours a day looking at charts, which I'm not interested in. I guess we kind of talked a little bit about, what are some of your favorite dividend stocks or what are your biggest holdings that, or just companies you always could use some more of?
Yeah, for sure. So I'll go with, I guess, the biggest holdings in my portfolio. And, again, honestly, the foundation's the biggest. That's my base. I'll never hit rock bottom because of it. So that always gives me more of the confidence to invest in, take some more risk on here, take some more on risk, over there. But VTI, Vanguard Total Stock Market Index Fund, just over 4,000 positions in there. You get it all. Everything from value and growth, large cap, mid cap, small cap, everything's in there. So that's my baby. That's like the foundation of my portfolio. From there, it's Apple. Apple's in the next largest position in my portfolio. I got Johnson and Johnson, Realty Income, Procter and Gamble, and Visa are two that I'm like waiting to get in on. But I love Procter and Gamble and Visa. Huge mistake a couple of months ago not getting into those companies. Ironically, on Tip Ranks, you have the ability to make a smart portfolio. And I made a smart portfolio with a virtual $10,000. Go figure. I made a little dividend investment portfolio. I'm looking at it. I'm like, wow, if only I actually took my virtual advice and plugged it into my portfolio. But that's all right. Lockheed Martin's a favorite one for me. I think Lockheed is pretty interesting. I mentioned it a couple of times. I actually think the video that I just dropped today mentions it. But it's one that I love, and I love it. You got the U.S. government, their largest client. I mean, you can't get a better book of business than Uncle Sam with his deep, deep pockets, right? Always wanting to up the ante on the arsenal, warfare arsenal. But Lockheed is one that I'm actually avidly trying to grow. It's it's a bit more expensive, if you will, but right now I like it. I like where it's at, and I'm talking about expensive in terms of the stock share price, because then I look at some other ones that are out there, that are cheaper that I think also deliver a fair amount of value. Trying to think, man, off the top of my head, what else is out there in my portfolio?
Those are all really great names, and yeah, I mean, Lockheed's a really interesting one. I'd actually gone to there's this Air Mobility Command Museum around here in Delaware at the Air Force Base, and you've got these massive planes. One of them is the C-7, which I believe is the largest plane in the entire Air Force. Who built it? Lockheed Martin. Who built the giant missile that it carries? Lockheed Martin. Yeah, that you can't go wrong with the government as your biggest customer, as you said. So yeah, those are all great names.
They recently just did a handful of modification deals. But by the way, this is also what I'm talking about, just to kind of come full circle. It's you can't keep track of 70 companies, but 5 to 10, you can kind of get a grip on, right? So Lockheed Martin just did an amazing 5 deals with the U.S. government, Department of Defense, U.S. Navy, right? One was for $350 million. Another was for $2.7 billion. I mean, these are all modification deals on aircraft, missiles, right? And just I think I don't want to get at all into politics, right? Because I feel like you can't even talk politics anymore today. But for me, I am a centrist. So it's give me the best man or woman for the job. Let them run the company or the country, right? Either way, and let's rock and roll. But what I feel like right now is just looking down the political lens. If there is going to be a Republican flip, right, Lockheed Martin's likely going to do very well. And if it's not going to turn Republican, still okay, right? Give me the best man or woman for the job. Lockheed Martin is still going to do very well because the U.S. is due for, again, the upgrades and modifications, which is what we're seeing right now. And so it gets pretty exciting to invest into a company like Lockheed Martin, point in case with the deals that they have. And, on top of that, you get your dividend. So your share price appreciation and your dividend. And I also, as you were talking, I just looked at the portfolio. I'll also share 2 big ones that I really love right now. Is Stanley Black & Decker that I bought 6 months ago at its bottom. And working at Tip Ranks, right, you're with all the analysts. So every analyst ever was sell, strong sell, strong sell. I was looking at this and saying, no way, this is a buy. This is a supplier to Home Depot, Lowe's, all the mom and pops, right? Think Warren Buffett invested into home builders, right? Multiple home builders. Where are all the home builders getting their tools? From Home Depot and Lowe's. And where are they getting the tool, right? Like you follow the money path and it leads back to Stanley Black. So Stanley Black will be back, man. And I invested into it. And a few months later, here I am, like I'm up. I think it's going to have a great run for the money. I'm not going to keep it. It's not a stock I'm going to keep in my portfolio for like the next 5 to 10, but it's one I'm excited about. And also, to be honest with you, I feel like this one might get some heat for is Tyson meat. Dude, you got the biggest producer of beef, chicken, and pork that has just been crushed by economic conditions. And you got, again, like whether it's Jim Cramer being like, oh, this is a bad stock, get away from it. I don't care. I'm thinking 2 years down the road, 3 years, 5 years down the road. So when I think it was, who was it? The CFO or the CFO's son or whoever like got arrested because he ran into some woman's house and jumped in her bed because he was drunk. I was like, yeah, load on the negative news. That's great, right? The stock's falling and you got this naked, CFO or whatever running around and making a bad name for Tyson. This is great news for an investor like me. So I got into Tyson again at the bottom and I'm still already profiting and riding the wave up. But I think in 2 to 3 years, when we get a nice economic turnaround, it's where I'll pull some Peter Lynch into this picture. Like I look at Tyson Foods and I say, Tyson will also be back, right? Because the economic conditions will change. Interest rates will probably begin to come down. Inflation's going to be lower. Right now, the cost of animal feed because of interest rates and inflation, sky high. The cost of transit, sky high. So I'm not afraid to jump in. This is now what I call risk, right? With a riskier Tyson or Stanley Black & Decker to ride the upward wave of momentum when these stocks come back and the economy turns.
Yeah, that makes sense. And you got to go inverse Kramer on this one, I think, because like every other stock, because like there was the whole plant-based meats thing. It is not going anywhere until they actually ban meat and make us eat bugs or whatever the plan is. Yeah, no one wants this stuff. Like you saw Beyond Meat stock went up to 200. I think it's like $10 now. Like, yeah, so that makes sense. They've got basically they're like a monopoly on all the essentials for the American diet here. What are your thoughts on like? Are there any names that look particularly appealing to you as a buy today? I guess that was one. And like I know I've been seeing these REITs are just getting destroyed. I mean, Realty Income's down to $55. Like I don't know here.
It's a great question, man. It's my list right here. Before I do my videos, I do so much. Ryan Williams. This is a shout out to him. One of my buddies that I'm very closely connected with on YouTube. We're always talking about stocks and videos and what we're, going to talk about X, Y, and Z. And he was like, man, I feel like you pour so much research into your videos. And so Ryan Williams is making first of all, he took YouTube full time. Hats off to him. He is making it happen on his channel. If you haven't checked it out, definitely jump there too. But he's producing videos every day. And I work a full-time job, and then I like researching stocks. I really like doing the due diligence. So it takes me a little bit longer to produce more videos, but it's because of this research end, and he's also got a lot of research going on. His is a lot of unscripted work, right? He'll do it right there in front of you on the camera. Mine's like, hey, I'm going to take it early mornings or while I'm at tip ranks, right, with all the data in front of me to start doing some work. And so I write my list down of the tickers and I start just going through these. But yeah, man, I have some ones I'm like really looking into, right now. Of course, a video came out today that 5 stocks that I think are pretty solid. Lockheed was actually a part of that list. One that wasn't on that list that you just mentioned is Realty Income. And that's one that's coming down, that's fluctuating with the market. And I think a lot of investors got scared away with this new Bellagio deal. I don't know if you're familiar with their new Blackstone buy there. They had a deal with Blackstone where they were going to buy the Bellagio Las Vegas. A lot of it, retail investors got scared away from this deal, I think, because it's a bit out of their niche. This is their second gaming investment, entertainment / gaming investment. The way I look at this picture is I'm behind the team, right? Like the Realty Income team. I trust their management. Again, money aside, I would work for Realty Income. If I'm not in the States right now, but if I were to jump back into the States and I used to work in real estate in Manhattan, I would love to work for the Realty Income team. So, going back to Realty Income, I would definitely invest into them. I actually did last week. I picked up some more shares. I like seeing their stock share price at 55 and below. 60 and below is good. 55 and below is great, right? So I hope for 40, right? Like that's fingers crossed. Looking into some of these other plays as an interesting one right now, even though it's probably always going to be overvalued, is McDonald's. And I say that because I'm a big economics, macros matter guy. So I'm thinking about, what is the year going to look like ahead for us? Will there be volatility? And moreover, because McDonald's is probably never going to be undervalued, let's face it, like it's McDonald's, here and there, I will, no problem, buy a share here or there, right? Because I know it's not undervalued, so I'm not going to throw a lot in it, but sprinkle some in. Yeah, man. And then Darden Restaurants has been one that I have been really thinking to be a juicy investment. Darden Restaurants is one that I've talked about now for a couple weeks. I'm amped about it because I invested in 2020, March of 2020. So they're a restaurant operator with like 11 different brands underneath their belt. But I'll give you like the top 4 or 5 of those brands. Olive Garden, gotta love those breadsticks. Longhorn Steakhouse, right? Like Seasons 52, the Capitol Grill, and Eddie V's. All restaurants of which I've eaten at before. Not a big Longhorn Steakhouse fan, but when I was in Manhattan, I was always at the Capitol Grill. So it's like somewhere I would go. I love their food. I don't think they're going anywhere. But when they slide, it's typically, again, because of economics, right? Our economic backdrop, we got a lot of penny pinching going on now, probably slower growth for Darden Restaurants right now. So you get investors who are backing out of it. Stock share price slides. Contrarian investor, I'll go in and buy it then. And, I think regardless of what happens in the next 12 months, I think we'll probably get a bit of a downturn. But regardless what happens, what I think for Darden is that people are still going to go get some breadsticks from Olive Garden, right? Like people are going to continue to go to the Capitol Grill. Capitol Grill is a bit more expensive, but not so expensive the everyday Joe can't go there. Matter of fact, at happy hour or lunch hour, right, when I would go, my boss and I would sit down and order lunch, and a bunch of average Joes are around us. So it's like you want to feel classier, but yet get a good steak. Go to the Capitol Grill. You want to go Italian? Get some breadsticks, right, at Olive Garden. Feel like you're in Italy. I don't know, but these restaurants will take you there, and so that's one I'm excited about too.
Yeah, that makes sense. As far as restaurant plays go, I started doing some DD. I definitely do more, but one that's very intriguing to me, doesn't pay dividend, but it's Chipotle. Love Chipotle. I don't know about you. I could eat it every day. And, some of the things I did find that were very interesting. I mean, I think it's a great company. They're innovative, the great management team, but they're doubling their restaurant count, over the next few years, whatever the plan is in the US and Canada. If you look in 2022, what was the number one ordered item off of like DoorDash? It was a burrito. So I think they kind of have a lot of tailwinds with like maybe changing consumer preferences, like Chipotle. I definitely, it's been like on my list. And that's another one though. You never get it for cheap, but I got to do some more research, but that's one I've been looking to potentially add as well.
I hate looking at stocks like that. Like you just said, and I said it minutes before you, right? Like it seems expensive. But like in the spectrum of things, is it expensive? I'm like, that's where you got a question, right? It's like Lockheed Martin's at $450 per share. Developing missiles, right? Like we're talking about contracts with the U.S. government for millions and millions of dollars. Yeah, it's probably going to be expensive, more expensive than like a bean burrito. But like to your point with Chipotle, again, doubling their restaurant count, like, yeah, they're going to be expensive. You'd actually appreciate Bill Ackman's portfolio, man. Chipotle it's been a holding in there since as far back as I can remember looking into the Pershing Square portfolio.
Yeah, I know he's big on it. Gary Black, he's big on Chipotle as well. But that's one that intrigues me for sure. Well, we're coming up on an hour here. Was there anything else you wanted to talk about today?
Man, on the top of my head, I'll throw a question your way, actually. I'll end it with a question for you, man. When the hunted becomes the hunter, right?
Tables have turned.
Yeah. I wanna know, after our conversation here, what do we got on the clock right now? 53 minutes and 40 seconds we've been on here. Have I changed your mind at all about any dividend stocks or dividend investing?
Yeah, you definitely gave me some ideas here of like some companies I want to look more into because I think you're right. Like a Lockheed is something that just makes sense to just have on that list forever. So yeah, definitely, gave me some ideas here, and I feel like this is the whole thing. Like as creators and as investors, there's so many companies. There's only so much time in the day. It's easy to kind of get lost in it all and all the numbers, but like when you actually talk to someone, you listen to a conversation or podcast, it helps, it kind of gives you some signal in the noise. So yeah, this has been great, and thank you for coming on. It was a blast. And where can people find you?
Right on my channel, Ari Gutman, just type it in. But more importantly is supporting Vinny. He's doing great work. Be subscribed to his channel. This video for him, right? Like Vinny, every video I've been watching since we've been connected, man, I've been watching a lot of them. You always got to do your due diligence right before jumping on anywhere. But man, you got a lot of great work. So forget me, right? Like and subscribe to Vinny's channel, and keep supporting the creators who are out there doing the due diligence for everyone out there, right? In the firing lines. I feel like, guys like me and you, Russ from Dapper Dividends, Ryan Williams out there, even Jason Bieber, all of us, we're on the firing lines doing a lot of this due diligence. And yeah, it's fun sometimes being on camera, but I think that the best thing anybody can do is support the creators who are doing the due diligence, entertaining people, but also sharing insights and information. So I'll leave it at that, man. And want to say thank you so much for having me on.
Yeah, my pleasure. Thanks for coming again, and I'll link to Ari's channel in the description below. Everyone should definitely go check him out. Thanks for watching, everyone.